So by now, having completed the course so much, we know what options are. But if somebody says that I know what are options, but I do not know what are option Greeks, then it would be something like saying that I am a deep sea diver, but I do not know how to swim. So therefore, now we need to understand what are option Greeks. But before we answer this question, we need to answer another major question, and that is, what are the factors which cause the option premium to change? So this is the option chain of Tata Motors, which we have been looking for at so long. What you see in the center is the strike price or the various strike prices. On the left of the strike prices are the call premiums, and on the right are the put premiums. All right. So the question to be answered is, what causes the premium to change? We know that these premiums don't remain constant. They change from moment to moment and from day to day, isn't it? So the first thing which affects the premium is the spot price. If the spot price increases, then the call premium will increase and the put premium will decrease. We know that. We have already studied this. Alright. So you can understand from this that if the spot price has increased from 337.4 to say 360, then this line will become the ATM. This, what is red here on the left, will become green. What is green on the right will become red. All right. So all these premiums will change. This premium from 14.3 would have increased much higher than this. We have already studied this. We know it by now. All right. And the second thing which affects the premium or which causes the premium to change is the time decay. This also we have studied adequately. As the number of days to expiry keep reducing, the premium will keep reducing. No need to deliberate further. We have already studied this. And the third thing is the strike price. The strike price also causes the premium to change because the strike price determines the intrinsic value of the option. As the option becomes in the money, the premium will increase. We know that. So more and more the option becomes in the money, the intrinsic value will go up, time value will come down. Say for example here in 40 or all these green you see, in all these cases the time value is gradually reducing but the intrinsic value is increasing, and the resultant effect is that the total premium keeps on increasing as you go more and more in the money. Here also for the put options also, as you go down more and more into the money, the premium keeps on increasing, isn't it? And the more you go out of the money, the premium will keep on reducing. We have studied this, so no need to deliberate more. And the fourth thing which causes the premium to change is volatility. What is volatility? It is the difference in the minimum and the maximum price of the underlying asset during the day and from day to day. How much is the price fluctuating? Say if the spot price at a given moment is 337, how much is it moving within the working hours of the day? Does it become 325 on the lower side and 345 or 50 on the upper side? Or does it remain just close to 337 only? The more close it remains to this price, the less volatile it will be. The more the variation between the minimum price during the day and the maximum price during the day, more volatile the stock is. So if the stock is volatile, then for the call option buyer or the seller, it increases the upside potential for the call option buyer, basically because one buys the call option for the price to increase. So if the volatility is more, the chances of hitting the upper side is more. Similarly, for a put option buyer, he wants the price to go down. So if the volatility is more, then the chances of going down are more, or the chances of hitting the lower end is more, isn't it? So higher the volatility, higher will be the premium, lesser the volatility, lesser will be the premium. And then the interest rate. As the interest rate increases, the call option premium will increase and the put option premium will decrease. Now the interest rate do not affect the premium or the this option price or the premiums much. So these can very well be ignored. But just for academic interest, let me explain what is meant by the interest rate influencing the premiums. Say for example, in case of call option, why does a person buy a call option? He wants to buy at a lower price and then sell at a higher price. That is it. So if you buy, say for example, 2850 shares, that is because the lot size 2850, you need this much money, 961,590, if you actually buy the share of the company Tata Motors. But if you buy one lot of option, then you don't have to pay this much of money. You can just pay this premium multiplied by lot size, so it becomes 60,500. You see the vast difference, and that difference can be invested into some bonds or some fixed deposits which can generate some interest. So buying a call option is beneficial as compared to buying the shares for a person who wants to invest for a short time and earn by the increase in price. So because of this benefit which it is getting by buying the options, he has to pay a little more premium, because the person who is selling the option will demand a little more premium. That is the market forces, all right? And now coming to the put option. Why does a person buy a put option? Because he wants to sell at a higher price and then repurchase at a lower price. That is the purpose of put option. So if you actually sell the shares, then selling the shares, 2800 shares, if you sell 2850, then it will bring into your hands so much of cash, 961,000 cash it will bring into your hand. All right, that money can be invested to earn some interest. But for the person who is buying a put option, he has to actually pay the premium. So in case of put option, buying an option is a disadvantage. In case of call option, buying the option was an advantage, and therefore he had to pay a little higher premium. But in case of put option, buying a put option is disadvantageous as compared to actually selling the shares, and therefore because of this disadvantage, the buyer of the put option has to pay slightly less premium. Just for academic interest, even if you have not understood this, will not matter much. All right, so now you see that these are the forces which are influencing the option premium or the option price. Option premium and option price means the same. All right, what are these? The spot price, the time decay, the strike price, volatility, and to some extent, of course, the interest rates also. Now things would have been very simple to understand also and to calculate also, had all these forces been acting in one direction, either in favor of the option premium or against the option premium. But it doesn't happen like that. These forces act in different directions. For example, if you see, consider time decay and the asset price. All right, now you know that time decay, say for example from 43 days to 20 days, if it comes down, if the time left for expiry comes down from 43 days to 20 days, so obviously the premium will fall down. We all agree with that, we have studied this. If the price of the asset or the underlying asset keeps increasing, say from 337 to 355, then that would cause the premium to increase. So one force is causing the premium to come down, the other force is causing the premium to go up. What will be the net effect? Quite difficult to first of all understand and then calculate. All right. So how and how much these forces influence the option premium or the option price is measured by certain financial terms or tools which are called as option Greeks. All right. So what we have seen here are not the option Greeks. They are actually the forces which are influencing the option premium. And the tools or the financial terms which measure how and how much these forces are affecting the option premium, they are called as option Greeks. So we will be studying the option Greeks. Now the point is, by studying the option Greeks, the Greeks will tell you how much these things are affecting the price. But ultimately, when you buy or sell on the stock exchange, looking at your computer screen, you are actually paying the price what is mentioned there and receiving the price what is mentioned there. You can't do much about it. Then what is the difference? Why should you understand all these forces and the option Greeks? You see, by learning and understanding this, you will be able to broadly calculate that the price which you are paying or the premium which you are paying is likely to earn a profit for you or not. A smart trader will take all these things into consideration and then he will decide whether to buy or to sell and at what price to buy and at what price to sell. He can also go wrong, but when he does so by studying and understanding the things, then the probability of him getting right are more. But when you do the same thing by speculation, then your chances are 50-50. You may be right, you may be wrong. All right. By speculation, your chances are 50-50. But when you understand things, calculate, comprehend, and then do it, then your odds are better. Maybe 7 times out of 10 you will succeed, 3 times you may go wrong. And that is what is required when you do trading in options. All right. So in the next lesson, we shall actually see what are option Greeks.